the latest from Senator Manchin, and it's not just the latest, he's been saying it for a while. Inflation was on his radar screen. He thinks that part of it is the result of proposed spending. And at the same time, I saw one of the president's chief economists, one of his guy, I think he used to be the vice president economist when Joe Biden was vice president, Jared Bernstein, saying we need this $1.75 trillion plan to lower inflation. Is there any precedent? Is there any fuzzy math that you can use where that would be the end result of another, really, $4 trillion in spending?
I'm not seeing it. When you look at all the transfer payments, all of those have income phase outs, which means that they raise effective marginal income tax rates. When you look at the business tax provisions, whether it's on the corporate tax, whether it's on the buyback surcharge, which is going to impede the reallocation of capital from cash-rich firms without profitable investment opportunities to cash-poor firms. When you look at all of these provisions, it is going to deter labor force participation, and it is going to deter business investment. And that's not good for the supply side potential of the U.S. economy, and it's not good for easing the inflationary pressure.
At this point, are we already on this path? And it's a path that's troubling. I don't know if anyone, not everyone remembers the late 70s, early 80s, and what that felt like when you really do see any wage gains just totally evaporate with inflation. And then it seems to come home to roost in GDP growth, and that slows. And then we enter the worst case in both scenarios, and that's stagflation. Are we on a path, in your view, to an extended period of slow growth and high inflation? Is it too late to save us?
So I don't, at the moment, see a replay of the stagflation, certainly of the 1970s. But when I look at the bond market, certainly I think the bond market is telling us that there is an expectation, and I think it's a reasonable expectation, that inflation is going to remain substantially elevated. We see that when we look at the 5- and 10-year inflation break-evens. The bond market is also telling us to anticipate very modest, low growth because even as inflation break-evens have been rising, nominal yields have been falling, which to me says we are in for very slow growth with inflation still quite elevated.
It's been pointed out that when inflation levels were at where they are now, interest rates were like 8%, Fed funds 8%, mortgage rates 10%. And maybe, we choked, remember Volcker and what happened to break the back of inflation, but we're not doing anything right. How can you possibly think you're going to bring inflation down when you're just starting to even talk about tapering, not even raising rates? How are we responding to this threat right now?
It is pretty staggering to consider that between now and the anticipated end of the taper, the Federal Reserve is going to add another $500 billion in asset purchases into financial markets. And the overnight real Fed funds rate is effectively negative 6%. That is pretty staggering.
Well, I just don't see how it doesn't end badly. Where did you say you're seeing in the bond market that there is an inflationary fear? Well, we went from 141 on the 10-year back to 155.
So when you look at the inflation break-evens as implied by the difference between regular Treasury securities and the Treasury inflation-protected securities, we just yesterday saw the 5-year break-even go over 3%, and we saw that, which I believe is the highest on record, or at least since the early 2000s, and the 10-year ticked up to 2.7%, so inching toward 3.